Hi, I'm Ben and welcome to Motivation to Invest. Our mission is to motivate you to invest for your financial freedom. Whether that means escaping the 9-to-5 drudgery or just improving your quality of life, I'm here to help you by providing you with valuable investing tips and strategies. Peter Lynch is one of the most successful investors of all time, and as mutual fund manager at Fidelity Investments, he produced an over 30% annual return, despite market downturns during that time. In short, he beat the stock market, which is extremely difficult and rare to do. In his book, One Up on Wall Street, he talks about the many advantages amateur and beginner investors have over large institutions. Now, I did a full review on this, which you can check out on a previous video. I'll leave a link below. So in this video, I'm going to explore how you can select a 10-bagger stock and make your £1,000 investment turn into £10,000, £100,000, or even £1 million. So these 10 points are very, very interesting and very, very counterintuitive to those who are in, say, large investing firms. Coming in at number 10 is to look for stocks and companies with a dull or ridiculous name. Now, if a business or a stock is named Magellan Pineapple Co., large institutional investors will be very wary of investing in such a company. Even if the company has great cash flow, great prospects, great market share, they still may be hesitant to invest in this company. Because if that company had problems or had issues, they'd have to explain to their investors that they invested 50 million or 100 million or even $1 billion into Magellan Pineapple Co. And it can not give them very good authority when they're trying to explain to an investor. However, there's a quote in the book and it says, nobody ever got fired for investing into IBM. Now, IBM is a safe blue chip stock, and it definitely was back in the 80s when this book was written. And no large institution will ever say to one of their mutual fund managers, right, you're fired because you invested into IBM. So even if these companies, these large institutions, are producing mediocre returns, it's fine. It's fine because the mutual fund manager is still going to get paid, he's still going to get his commission, and he's not going to look bad to the investors. But this opens an opportunity for amateur investors. You haven't got to explain to a boardroom why you chose Magellan Pineapple Co. over IBM. You haven't got to explain that to anybody. You just look at the facts, the figures, the prospects of the company, and if that company is going to produce you a 10x return, then it's a great investment. Who cares what the name is? But large institutions do. This brings me on to number 9. Number 9 is the company does something dull. So if the business does something really, really dull, really just not interesting at all, many large institutions will not even notice the company in terms of its progression or how it's working, how it operates. For example, a company called, say, Bottle Cap Co., and these supply bottle caps for bottles. Now, that is not a very exciting industry. It's not a very crazy industry. But if they're the market leader in that industry and they have great cash flow, great prospects, they're number one, and they're growing and they're undervalued as a stock because no one's really noticed them, then it could be another potential great investment. And the large institutions will just miss out on this because they won't be investing in such an obscure, dull-sounding company. And even a lot of private investors, they just won't invest in it because it just sounds boring. People invest in things that are more exciting, like Tesla or Apple or Google. It's just a bit more exciting and interesting. And those are good stocks as well. But in terms of getting undervalued stocks, you can get those a lot if a stock has a dull name. And that brings me neatly onto number 8. And that is investing into a stock if it does something which is disagreeable. So burial companies are a great example of this. So there's a certain burial company in the USA and it's just got a massive market share. It's obviously got repeat custom because people are always dying. And it's just got great potential, great cash flow, great balance sheet. It's a great business overall. But because it does something disagreeable, burying people, funeral services. It's often overlooked as a stock. No one really wakes up in the morning and says, right, I want to invest in a burial company. It's just not got that sex appeal about it, which other stock investments may have. But that can mean it can often be overlooked. Same with a boring company. And you can get a great value stock there, which can give you 10x return. This brings me on to point 7, which is it's a depressing company. For example, this could be a company such as, say, Roadkill Co. And their job is to collect roadkill from the side of the road. Now that is something a bit depressing. It's not that engaging or exciting. But they could be number one market leaders in that business. They could have great cash flow. They could have great expansion. And they're just going to get a lot less competition. People don't wake up in the morning and say, I'm going to create a roadkill collection company. They just don't do that. They'll wake up and say, I want to create a bar company. I want to create a new app. I want to create a new rocket ship. Like they'll create new exciting companies. Number 6 is look for a business which institutions don't own. So you can actually check out a lot of these factors. It's public available information. You can check whether a stock is owned by many large mutual fund investment institutions because they all seem to go for the same stocks. So if it is owned by these institutions, which many good stocks are as well, you can imagine a lot of capital is going to be poured into those companies. Thus, the stock price will be usually heavily inflated. However, if the company has not been discovered yet, usually if it's a smaller cap stock, large institutions won't bother investing into a real small cap stock because it's just not worth it for them to even just get involved. So that means as an amateur investor, so you can observe these smaller cap companies which you know are doing really well, and you can decide to invest in them early and get a great share price and get the full growth of that company, which they can be over 50-60% a year, which is fantastic and much better than you'd get from a large institute or a large stock on the S&P 500, for example. Another interesting stock to look for is in an industry which isn't growing. Now, the idea behind in an industry which isn't growing is to look for stocks which will have less competition because it's not this new and exciting industry. It's a very, very established industry which you're very unlikely to get vast numbers of new competition coming in. So Coca-Cola, obviously, soft drinks, beverage company. They've been established for a very, very long time, very successful stock. They've got a real monopoly on the market because they don't just do Coca-Cola, they do all the other types of soft drinks. So when you're choosing a soft drink, most likely you're going to be paying them. Now, yes, competition can come in. For example, Innocent, who had the smoothies, they came in. Exciting new company with main points on health, looking after your body, fruit, smoothie, which is complete opposite to Coca-Cola. However, what did Coke do? They just acquired them. So Coke just purchased Innocent Smoothie Company, and then now they own them under their Coca-Cola umbrella. Now, not many people know that. So the loyal customers of Innocent Smoothie, they'll go there, they'll still buy the product, they'll still be happy, they'll still feel like they're doing something for the environment and their health. However, it's owned by Coca-Cola. That's an industry which isn't growing, say, as fast as artificial intelligence or electric vehicles. Like electric vehicles, it's definitely going to be the future. So you can expect a lot of competition in that area. Any new technology, expect a lot of competition. Like I remember when Bitcoin and cryptocurrency, when they suddenly boosted into popularity, 1 million websites popped up online, 1 million businesses offering cryptocurrency exchange, cryptocurrency investments, cryptocurrency trading. So as it was a new industry, a lot of competition just developed out of nowhere because no one was really established as the number one in that industry. Number 4 is in a niche. So if a business or a stock is inside a very specific niche, it's likely to be one of the best in that niche. For example, if you have industry-specific knowledge, if you work in the medical profession, you may know a certain type of chemical is number one to fix this certain type of disease. And you know that every doctor in the country uses this specific type of chemical. Now that could be an interesting stock to look at. And if this company just makes this chemical, but they've got the monopoly on that market or this certain medicine, then that could be a great investment and it's worth doing some further investigation to do some more research into if that stock is a great investment. But if they are number one in their niche and they have that whole area boxed off, it can be a great investment, and it can often be overlooked by large institutions. Number 3 is the company has recurring revenues. So these are companies which may have a subscription service or repeat custom. So Spotify is a great example of this. Amazon Prime is a great example of this. Netflix is a great example of this. These are companies of which their customers are on a subscription-based service. Now this means the company can build up a massive customer base and then just build their new customers on top, and then new customers on top, and then new customers on top. Whereas certain industries, the customer might only purchase their product once and then they never see their customer again, or maybe twice, and then they'll never be able to sell to that customer again except having to sell a new product to them via email. But with subscription services, you've got that customer for a very, very long time. It just means the customer value is a lot higher. Number 2 is to look for the businesses which use products and services which you enjoy. So a great way Peter Lynch mentions in the book is if you're using a specific product or service, say for example Netflix, you use Netflix, all your friends use Netflix, you know everyone else is using Netflix, and say this was 10 years ago, and you're thinking, okay, this could be an interesting stock. And you do a bit more research, obviously you notice that VHS is going out, DVD is going out, and you start doing a bit more research in the company, and you see actually this is a fantastic company, and you get on that stock when it's small, then you would have achieved fantastic returns by now. Coming in number 1 is insiders are buying back shares. Now, this is something you should really check up before investing in a company. You should research if board members in the business are purchasing shares in their own company. This shows that the company has faith in itself, and they obviously have some inside knowledge about how well a company is progressing and if they are optimistic about the future. Now, there's one caveat to this. You should be aware that certain companies which maybe don't have too much integrity at the top, they may buy back the shares in order to inflate their stock price falsely. However, earnings will always correct those inflation. Now, I did a more detailed review of Peter Lynch's book, One Up on Wall Street, so I'll leave that in the link below. And I also did a detailed video on how to analyze and value a company before investing in it. I used the Warren Buffett method, which I managed to invest in a few companies recently. I was making approximately £1,000 a week off this investment, but I'm a long-term investor, so it doesn't really make a difference to me, but still it shows valuable strategies of how you value a company and choose the right company to invest in. So if you have any thoughts on the points I mentioned previously, I would love to hear them. So yeah, drop them in the comments below. And if you enjoyed this video, go ahead, smash that like button and definitely subscribe. See you next time.